All right. Welcome, everyone. The first episode of the Financial Philosophers Podcast. Really great to have you all join us. We're really excited to take you on this journey. For the first episode, we really wanted to explore what we think is a really important topic. We're not going to talk about the stock market, we're not going to talk about investments. We're going to talk about your ability to earn an income as the greatest asset you will ever own. So you might be wondering, what does that mean? Danny, I'm curious to hear what your initial thoughts were when you're thinking about income. What came to your mind?
Absolutely. Yeah, I was a little surprised at the way that you kind of laid this out or suggested it. Um, hey, by the way, it's great to see you. Super excited to be doing
Likewise.
this. But yeah, I was a little surprised, what you see online, what you see on YouTube, on social media. So many like really well known, but maybe not completely financially certified people talking about is just like passive income, right? You have to earn passive
Right.
income, passive income. No matter what you're doing, it has to be passive. It's like the number one thing you have to
It's
do.
all the
That's what
rage.
everybody's pushing. Get rich, get rich quick. Earn passive income. Never have to work a day in your life, kind of deal. And so I was surprised, right? I think it's a great idea, and I definitely want to dive into it. But the way that you kind of suggested that, like, your earning ability is your greatest
Yeah, I
possible
mean,
asset.
you can talk about passive income all day long, right? But in order to generate said passive income, you have to first save up a large enough of a lump sum to actually generate that passive income to begin with.
Hmm.
And there's no other place for most people, right? Most people aren't getting large seven-figure inheritances. There are always outliers out there, but for most people, they're going to have to earn their income and save enough to then either buy certain assets that generate passive income or have a large enough lump sum to earn some type of interest or yield on it. So, but yeah,
Absolutely.
let's dive into that then. Like, another way to put it, when you say your ability to earn an income, there's actually a technical term out there. Sometimes you'll see it in legal definitions. One's earnings capacity,
Okay.
right? Like what does that mean? Like one's earnings capacity.
Oh,
So
yes. That actually comes into play in things like
yeah,
disability
or if
cases
somebody
and things like that.
exactly, if somebody is injured in a car accident, for example, and there's going to be punitive damages, where the person who hit somebody else is going to have to pay them some type of compensation or a payout of some sort. That's usually that conclusion is come to based on something called their earnings capacity. Like we're going to explore this a little bit. So we're not going
Okay.
to talk about the getting in an accident, but
Yeah, let's move away from the
exactly,
court
let's not
cases a little
scare
bit.
people here.
Absolutely.
But so like when you think about earnings capacity, if you do a quick Google search, for example, you might come across something online that says something along the lines of, it's your expected earnings over your lifetime, or the present value of all your future
Okay.
earnings, right? Like basically, it's your ability or power to earn money, right? And that has a real value. That has a real dollar amount. It's not just some like made up.
Like what someone might call an
Yeah,
intrinsic
you could say
value,
intrinsic
essentially.
value, present value. These terms are
Okay.
thrown around a lot, so we'll explore some of this and see if we can give our listeners some clarification on it. So, you know, what is the present value of someone's future earnings? What does that even mean, right? It's like one way you could put it is like if you were to stop working today, Danny, like how much money would you need as a lump sum right now in order to pay the same salary you would have earned for the rest of your working career? Like if you were given one giant lump sum,
Yeah,
how much would that money have to be to pay your income for the rest
absolutely.
of your career, right? That
I'll be honest, I have not run those numbers. But right off the top of my head, like I think it's somewhere between 2 and 3 million, someone could get me to
okay.
stop
Yeah,
working.
well we can explore that a little bit. It's an art trying to come to that number, and it is subjective too. You'll see. Um, the idea of quantifying how much your future earnings are worth is an objective practice.
Okay,
Like it is mathematically sound, but there is a subjective element in terms of like the assumptions you make
sure.
and whatnot, right? So, for example, let's take somebody who's 30 years old, right? And let's say they're making $70,000 a year and they plan to work to age 65. So another 35 years of working, right? So essentially, if you'd say 35 years times $70,000 a year, that comes out to $2,450,000, right? So the question would be
Okay.
like, what
Yeah, that's right in the middle of what I
yeah,
had
that's
thought.
that's assuming that you have no growth on that lump sum, right? Like it's an equal 70,000 divided by 35 years.
Absolutely.
But we have to calculate
Yeah.
that a little bit. So like what lump sum amount of money would you need today in order to safely pay you $70,000 a year for 35 years? Well, before we do that, we have to assume that that money is growing at some rate. It's probably unreasonable to just assign it a 0% growth rate, right? Because even bank accounts right now in this current high interest rate environment, at the time of this recording at least, are paying in the 4% range. So 0%.
As long as you're using a high yield savings account,
Yes, exactly.
right? If you have a big name bank, you're probably not
Yes,
getting
which
those
that
numbers.
could be a future episode idea, by the way. But to our listeners,
Absolutely. Yeah.
if you
Dive
have
into
money
that.
sitting in the bank earning 0.05% interest, there are better options out there. But anyway,
Yeah. Your bank is taking advantage of
exactly.
you.
So 0% is probably not reasonable to use, right? I also don't think the historical stock market average is reasonable either, right? Because if you were, some people, there's debate over what does somebody earn historically on average in the stock market. A lot of people say like 8 to 10%. We could say 10% for the sake of
Okay.
discussion. If you were to stop working today and you needed a lump sum, the stock market is not necessarily a fair example to use when replacing your income per se in this situation, because you're only 30 years old in this scenario, right? And the stock market is highly volatile.
Yeah.
It's much more volatile than one's income is, generally speaking, right? Like the market can literally be up 30% one year, down 40% the next year, up 10% the next year. One's income does not do that. That's not a fair tip.
Typically, unless there's some kind of horrible catastrophe, yeah, your income does not
Exactly.
fluctuate like
And
that.
so, again, this is where it gets subjective. Some listeners may disagree. You may want to use that 10% number, in which case the amount of money you would need is much lower. But to me, I just took in a middle of the road approach. I said 5% for the sake of discussion, like somewhere.
Okay, so you're going pretty low overall. I do agree. I think 10% would be pretty
Yeah,
on the very high
yeah,
end and very
yeah.
optimistic. But you're going as low as
Yes.
five,
Well, I mean,
like a 5%
right. Because
annualized return.
in my mind, if I'm truly thinking like, if I'm stopping work today and I want to know what is my earnings capacity actually worth in a present value, I want it to be a sort of an apples to apples comparison. I would assume that with a lump sum, I
Okay.
wouldn't be dealing with irrational swings in value, and that doesn't lend itself to a normal withdrawal behavior or income, right? Like we don't see our income, our paychecks coming in every month, you know, going up and down in double digit values. That would really be difficult to
hmm
manage and would be unpredictable.
Well, unless you're a freelancer working in the gig
True,
economy, which there
true.
are a lot of people
That's why
moving to that now.
for any of our listeners at this point who are debating in their head like what number would you use, this is where the subjective element comes in. For my own personal
Yeah.
reasons, I'm choosing 5% just for the sake of taking the middle of the road approach. So I use 5%, right? So if that's the case, if you had a lump sum today and you assumed that that lump sum was growing at an annualized rate of 5% per year, then you would need $1.2 million roughly to replace that 70,000.
In order to
Right.
equal that
Yep.
70,000.
So
Okay.
if somebody's agreeing with these assumptions, which you may or may not, but if you are, that's basically saying if you are a 30-year-old making about 70,000 a year, you could make the case that that is literally worth $1.2 million right now, right? Like if you were,
hmm
this is a fun.
If you're somehow trying to like sell yourself to a spouse.
Yeah, well, actually, let's use that. Let's take that example even more nerdier for a second. So here's a fun thought: if you were a business and you were trying to like sell your stock on the stock market, right? If you were trading on the stock market,
hmm
your personal you, the business of you, the market value of you, what the price people would pay, would heavily factor in the present value of all your future expected earnings. So
hmm
if you had a valuation on the market, it might in using these assumptions, right? Which valuations of companies on the market are using assumptions, then maybe you'd be in the $1.2 million range. Plus, there'd be other factors you'd consider, but this
All right, I'd like to
Yeah.
argue or think maybe that that Daniel's market valuation would be higher than 1.2 million for the remainder of my life. I
Yes,
hope.
you're exactly right, because and it likely is, right? So let's explore that for a second. This is assuming a perfectly static environment, right? You always make
Hmm.
$70,000 a year every year for the rest of your working career. That's also not a reasonable assumption to make, right? Most people hit their peak earnings usually in their 40s or 50s, right? That's usually when their income is at their
Yeah,
highest.
late
Yeah.
40s
Yeah,
to
so
early
this
50s. Yep.
30-year-old in this example might not even hit their peak income for another 15, 20 years. Um, and by that point, it's not unreasonable to assume that that $70,000 figure could easily be worth double or more, right, over a working career. It's
Hmm.
totally reasonable to think that somebody making 70,000 at 30 years old by the time they're 50 are going to probably be comfortably in the six-figure area, assuming that they are, working to increase their earnings capacity and progressing in a career. Obviously, that's not
Absolutely.
the case for everybody, but I think that's a reasonable assumption to make. So if that's the case, how to your point, Danny, like you think you're probably worth more than a $1.2 million valuation in terms of your earnings capacity. I would agree, right? If you assume that your income increases either via annual raises at some set percentage or changing jobs or switching positions in your career, that value will dramatically increase. If we were to simply just increase that $70,000 a year to $90,000 a year, that $1.2 million present value is going to jump up dramatically.
And that, ladies and gentlemen, is the power of compound interest.
Exactly. Or compounding. Yeah, it's funny. We
Well, compounding
yeah,
growth, compounding
however you
interest,
want to
however
put
you
it,
want
this
to look at
this
it.
idea of
Yeah.
compounding is so present in many different areas of finance, and not just interest, but like we're talking about right now. Exactly. So yeah, as your income goes up, right, your earnings capacity is going to be worth more. And the opposite's also true. We used a 30-year-old, right, making 70,000. If we took a 22-year-old out of college making 70,000, that present value of all their future earnings is going to be worth a lot more than 1.2 million as well. Yes, because they
Vastly
have time
higher.
on their side. And now that
Those additional years, if you're looking at an additional 8 years, 10
yeah,
years, more than a decade, that growth is
huge,
exponential.
huge. So like what's the point in us talking about this, right? I mean, the point is your ability to earn an income, your earnings capacity is literally super valuable. It has a huge number behind it. And it may, for most people, it may be the largest asset they ever own, right? Um, Especially in today's dollars, right? For this 30-year-old, 1.2 million
Hmm.
in this hypothetical example, right? I don't know many 30-year-olds that have a $1.2 million net worth. Um, yeah.
I certainly don't.
So
I'm a little older than 30, but yeah, I haven't hit that number yet.
so yeah. So I think the point comes across when you go through this example. There's a lot of value behind your ability to earn an income. So, um, you know, it, this also places a huge emphasis on why you should think of increasing your earnings capacity, right? So, for example, we know to your point, right, where you said I would like to push back and say I think I'm worth more than 1.2 million. Well, you are, or at least potentially you are, right? We are. Everyone is. But how? How does that happen? How do we ensure that we are worth more and that we do compound our value? Well, we increase our earnings capacity, right? I mean, we learn new skills. We try to advance in our careers. We try to get raises. Um, and doing these things are going to have, as you said, a compounding effect on your wealth, right? Um, I I don't know if this is going to be controversial or not to say this, but I would say that it's going to accelerate your wealth at a much higher rate than any return on investment you're going to find in the stock market, for example.
All right, so you're going kind of to the side where you do see some people kind of arguing and pushing for self improvement, like you are saying, increasing your earnings potential. but basically just developing new skills, um, getting a better education, not necessarily at an expensive university. I love certifications. I think that certification courses, trade schools, are an amazing return on investment for their price.
Yeah, I mean,
Um, but just looking for ways to constantly either master your current craft or develop an additional skill that has higher earning potential.
that yeah, I mean, t- that's a really cool example you brought up with maybe you get some type of I don't know, graduate certificate or postgraduate certificate. Maybe those are the same thing. I don't know, or some trade certificate, right? And maybe it's at a reasonable cost point. Um,
Hmm.
and you can reasonably expect that after getting that certification or learning this new skill, it might translate into some X dollar amount of raise at your job, right? Well, you could
Absolutely.
literally do the same exercise we just did. It's going to be a smaller number, right? But like, let's say let's say your income now increased by $1,000 a month, right? So $12,000 a year. And if you did that calculation on like what present value of this now new future earnings you have of $1,000 a month, what's that worth today? Um, that number is probably going to be substantially larger than maybe the price you paid to like do that certificate to begin with, right? Like, so it's almost like you
Absolutely.
could calculate an ROI on that, a return on investment, and it could be quite profound.
Yeah. And I know some people that might be listening might, you know, 12,000 might be kind of a drop in the bucket in a way. But for many people,
Yeah.
myself included, if you look at an additional $12,000 and I have zero lifestyle inflation, zero cost of living inflation, an additional 12,000 for me means 12,000
Yes.
invested,
Oh my gosh.
12,000 put to work, growing, compounding, seeing that exponential growth curve over time. In some ways, it's kind of addictive, honestly. I find myself wanting like, oh, my paycheck's here.
Yeah.
I want to put the whole thing, into index funds and watch it grow and watch those numbers. What's the meme? The numbers go up, right? I think there's a crypto documentary called "The Numbers Go Up" or something. But in terms of like market returns, and even instead we're looking at a kind of a more conservative annualized rate of 5%, growing 5%, like 12,000, growing
Yeah.
five
It's
percent year over year. For someone we're kind of
yeah.
middle class, I
Yeah.
would say. We do pretty well, but we're very frugal, and I think when you live below your means, that increase is just life
I
changing in a
actually
way.
got goosebumps when you said something just a minute ago. You said I have 0% lifestyle inflation. That that is worth talking about for a second here. Like I think, and correct me if I'm wrong, but I think you were also hinting at this concept of like spending creep, right? Like a lot of people fall into this trap
Yes.
that as their income raises, they just start spending more money when in reality they never needed to, right? They were doing just fine on their prior income. And for some reason, they have to
Hmm.
spend more when their income raises. And what you're saying with 0% lifestyle inflation means that when you truly increase your income, 100% of that increase is going towards your wealth accumulation. It's not going towards increased spending for the. Is that what you're referring to? Yeah.
Correct. Yes. Yeah. We we've been trying very hard. We are currently carrying no debt besides our mortgage, and our mortgage is very low interest rate, so it's what I would consider good debt.
Yeah.
But yes, just trying to be frugal and responsible with our money. I am willing to spend money on certain things. If we need to get something new, then I prefer to spend a little bit more and ensure that it lasts for as long as possible. But typically, we lean towards experiences rather than trying to find joy in like material things and purchases.
Yeah. I mean, 100% agree with you. And, if somebody was going through this exercise, I think what you're saying is this exercise, by the way, I'm referring to trying to quantify and appreciate just how valuable their ability to earn an income is, right? If somebody's thinking about this and they are tempted to spend that money, it's important to note that if you allow spending creep to cause you to spend more money with it, here's the tricky thing about spending creep: you don't realize it's happening, right? That's why it's called creep. It creeps up on you. If you allow this to take advantage of you, it undermines everything you work for when it comes to increasing your earnings capacity. So like,
Absolutely.
yeah, the present value of all your future earnings may be increasing as you increase your income, but you're not actually benefiting from it if your spending just increases in line with that. There's no net
True.
benefit.
In regards to that, I feel like I've kind of maybe pulled us off on a tangent a little bit. You had mentioned that you had a couple of examples of how that earnings increase would affect different people based on their spending habits.
I think the angle I was going to take here, and we can come back to that, but how the earnings increase affects different people. The angle I was approaching it from was, I made the claim earlier, which might be, again, slightly controversial, that increasing your earnings capacity will accelerate your wealth, maybe at a far greater rate than any return on investment in the market will, right? And what I meant by that was, everyone is so concerned about wanting to hit that next big investment and wanting to see all these returns that they think everyone is talking about, and because all of their friends and aunts and uncles and brothers and cousins are all raging about their awesome double-digit returns in a hot market, right? Although maybe not right now, but
if you're seeing constant double-digit returns, you should be managing
exactly
a hedge fund.
like this is where fear of missing out comes in. Where I'm trying to approach this is at the angle of like wanting to encourage people that there are much better ways to accelerate your wealth than just being overly concerned about a certain return on investment in your stock portfolio, for example. And let me give you an example here. So let's go back to this 30-year-old we were talking about. They're starting at $0 right now, right? And they're investing, let's use the $1,000 a month we talked about, right? Like maybe they took that certificate and they now have an extra $1,000 a month that they can invest and save, right? And they do this let's take the stock market return, the hypothetical return we said, which was 10%, I think. So let's say they're saving $1,000 a month and they're earning an annualized return on investment of 10%. How long would it take for that person to reach $1 million at that rate? Well, I'll do the math for you really quick.
Okay.
Yeah,
because I can't do that. I don't have a calculator.
269 months. So almost 22 point
in years?
22 and a half years roughly. Ballpark.
Okay.
Now let's say another person number 2, we'll say, same situation, 30 years old, they're starting with $0, but they put much more focus on increasing their income and their free cash flow to save more per month. And they're not spending as much time worrying about their market returns and freaking out about what stocks I need to hold to get a 10% return. They're just saying, you know what, I want to increase my free cash flow. And I don't care how they do it. Maybe they educate, they get a certificate. Maybe they rent out a bedroom in their house. They bring on another roommate, whatever. They increase their free
house hacking.
That
we'll
could be a fun
about
topic
that later.
too, yeah. But so instead of $1,000 a month, maybe they're now able to invest $3,250 a month. So $3,250, right? So an extra $2,250 a month more than person 1. Well, if we assume the same 10% annualized return, and they want to get to $1 million, well, it would only take them 153 months instead of 269 months, which is almost 13 years, like 12.75 years as opposed to 22 and a half years. But
okay, so a little more than half the time.
But it also, there's another angle you could look at this, right? So if we say, you know what, it took person number 1 269 months to get to $1 million at a 10% return, saving $1,000 a month.
Mm-hmm.
What does person 2 need to get in terms of an annual return to reach that same $1 million in 269 months, right? So took person 1 269 months to get there. How long will it take person 2 to get there at 269 months, saving $3,250 a month instead?
based on your prior numbers, I'm gonna guess about 5%.
I'm so glad you said that, because you would think, right? Our natural intuition would tell us like half, right? Half the time, or half the required return. Sorry.
Mm-hmm.
No. The rate of return that they would need is 1.16%. Yes.
1.16, just over 1%.
Yes.
1%. Less than
Yes.
inflation.
Yes. And we mentioned earlier in the episode that, bank accounts at the time of this recording, you can find high yield online savings accounts around the 4% range, right? So
Yep. I'm getting
yeah,
4.2% of the month.
yeah. So obviously, person two is saving $3,250 a month instead of $1,000 a month, and we're also calculating for the same time frame, 269 months. In a realistic scenario, it shouldn't take them the same amount of time to get to $1 million as person one. But for the sake of argument, the point we're making here is when you increase your savings ability, your free cash flow, the demand on you to have a higher return on investment drops substantially, right? So like, yeah, like
dramatically.
now you're
I mean, you're looking at a 10x for the person with the lower
right,
rated savings in terms of the return they need
right,
in order to
and
hit those
also a
numbers.
substantial
Okay.
increase in risk that they have to take to get there too, right?
Absolutely.
And
Yep. Yeah, because you're not going to see 10% returns on anything that's
no,
truly
and
safe.
not only that, I don't even like to call it a 10% annualized return, right? Because when people hear that, they think it's like, oh, well, if I have $100,000 in year one, it'll go to 110 in year, at the beginning, by the beginning of year two, and then it'll go to 121 because it just earns 10% per year perfectly in a straight line, right? It's
Yep. When actually what you're seeing is like this,
it is.
this,
Oh my gosh!
and every year you
Yep.
start at 100, then you're down to 85, then you're at 120, then you're
Right.
at 95, then you're at 140.
100%.
Yep.
And the experience that one has to go through to earn an annualized average return of 10% per year is tormenting. I mean, it's up and down.
If you're watching your portfolio,
oh my gosh,
it absolutely is.
And
yes.
here's another question I'll ask you. Which person do you think, person one or person two, is going to be better equipped to emotionally handle the volatility of their investments if aiming for that type of return?
Absolutely, the person that only needs a 1% return.
Exactly.
Because you're almost guaranteed. Like, past performance doesn't guarantee
Yes,
future
exactly.
performance, right? But a 1%, you're essentially guaranteed as much as you can be to be able to reach that over
within reason.
decades.
Yeah, I mean, obviously nothing's guaranteed, but like when you have a free cash flow of $3,250 a month, that gives you a lot more peace of mind than the person who only has $1,000 in free cash flow per month. Your capacity. Yeah.
I'm going to inject here. I'm going to interject here. I'm just going to say I realize for the vast majority of people that are listening, that is an absurd amount of money. I do not have $3,250 in free cash flow a month. I have children. I have daycare. That is a difficult thing to attain. And it's one of the reasons that I am looking towards increasing my earning potential. I'm learning new skills at work. I'm going after financial certifications. Yep. You have to be working on yourself and building yourself as like increasing your own valuation, as you said 100%. At the beginning of the episode.
That is a good question. Like, we should take a step back and talk about these numbers, right? Like, is $3,250 a month realistic? I think you're right that for most people, that could be really tough to squeeze. I mean, some people may only earn $3,250 a month, period, before you even consider living expenses, right? But as your career advances, as you increase your income, assuming you don't allow lifestyle creep to drip in, maybe you have a partner with you, right? And you have a dual household income. Over time, these targets, and you could set whatever target you want, but these targets can become more attainable. They can. And I would invite our listeners to not focus so much on the numbers we're using in these hypothetical examples. I think what's more important is the concepts that they're demonstrating, right? Like we know from talking about this that increasing your free cash flow per month, even if only by $500 a month, is going to have interesting effects on your ability to accumulate wealth. It's going to demand less on the required return you need. It's going to give you greater emotional stability to handle volatility in investments. And it's going to decrease
Absolutely.
the amount of time in literally in measurable months that it will take for you to hit a certain milestone, whatever that is. And it doesn't have to be 1 million. It could be 100,000, right? That's the important thing to take away from this. So, I think taking a further step back, like, what do we do with all of this information, everything we're talking about, right? Well, I think for starters, we should maximize our earnings capacity, right? And you do things like save more, keep your spending the same even as your income rises, right? Like talking about spending creep, like you mentioned earlier. Try to have 0% lifestyle inflation. I really love that term. I think that's awesome. That could almost be a future episode too that we discuss just on that. Look for other
Absolutely.
creative ways to increase your income. And again, this could be another future episode we discuss. Room hacks, right? Finding roommates, renting out a room in your house. Obviously, that has an effect on your maybe your lifestyle comfort. Maybe you're not used to.
Definitely, it's going to be feasible for some people and not for
Exactly.
others. I'm not going to move someone into my house when I have
Yeah,
kids.
same here at this point in my life.
But if I were solo,
Yeah.
absolutely.
I'm picking up another part-time job, right? There are creative ways you can increase that cash flow. Some of them may require you to experience a little discomfort in the example of roommates. I would say when you're in those situations, take advantage of it while you can, right? Don't use extra income you earn or increase in your free cash flow to spend more. Take advantage of it and leverage it while it's available and boost your earnings capacity, your savings capacity. We are going to have to, Danny, we're going to have to do an episode on this in the future. But
Okay.
On protecting your income. And where I'm getting with is disability insurance. I want to briefly mention it here because, right?
Interesting.
We're making the claim that your ability to earn an income may be the greatest asset you ever own, right? Wouldn't it then be prudent to maybe protect that asset?
Probably. I've certainly never considered something such as disability insurance. So, you'll have to explain that to me in the future.
Let's earmark it here, and that way our listeners can hold us accountable. We will definitely cover this topic then at some point in the relatively near future. But going back to what we're talking about here, what do we do with all this information we're talking about? Another thing is to simply recognize how valuable your earnings capacity is as an asset, which we've been hammering in at this point. But don't take it for granted, right? I hate saying this. It sounds so mean, but like, I met this person once in DC, and he was talking about his job with me. He knew I was a financial planner. I guess I should say that at this point. I am a CFP professional, certified financial planner professional.
And I am not.
So they naturally were curious about what I do and started asking questions, and they were like talking about their job, and the first thing I asked them was like, well, like, how's the cost of living here, and what's your income like? Do you have a decent income to your cost of living? And DC's can be pretty high cost of living in certain areas, but I think their income was, if I'm remembering correctly, in the 160 to 170 range. Very
That's
nice,
very high.
very nice income. And I had met them through a mutual friend, and it was like at some social gathering in DC. And we had this conversation. And I kid you not, 2 years had gone by, and I ended up running into this person again. And they struck up a conversation with me again about financial planning stuff. And I remember asking, like, I was like, I remember where we left off, right? Like, So where are you sitting at now in terms of savings? Because when I had initially talked to them, they had $0 saved. Like they had like nothing in savings. 2 years later, after earning 160 to 170, they had a whopping $9,000 saved after 2 years.
That is unbelievable.
I know.
I cannot
I know.
imagine that. When my wife and I, before we moved out west, we were living in the New York area, and cost of living there is incredibly high, and we were very low earners at that point. And even with that, we didn't have much problem saving 12,000 to move across the country, and that was when we were earning very low incomes.
I think this is just a prime example of spending creep, lifestyle inflation, right? Because as I asked more questions to figure out why they only had $9,000 saved, became very clear that they spent a lot of money. They were going out a lot, went out to bars, would drop $300 a night, high spending. And they were also talking about how much they hated their job and how they wanted to quit and would be much happier, and they don't care about the pay. They would just be much happier doing something else. I forget what that was. They had a couple hobbies or interests they had, but
I think, just to cut in, I think that's something you see pretty often. If someone hates their job but they are earning money from it, like a good income from it, they're very often going to increase that spending to compensate for that stress and that disdain that they're feeling.
And the point I'm trying to make is, we don't want to be irresponsible with our money, and we have to take advantage of our income while we have the chance. And if I were in that person's shoes, I have nothing but empathy, right? Because when we, like you said, when we don't enjoy the situation we're in, we tend to seek out distractions, and that usually comes up in the way of spending. But if you do want to leave a situation you're in and you're a high income earner, take advantage of the situation and save a lot of money and then just quit.
You have the means to do so. You can set yourself up with an incredible safety net to move towards whatever you want.
You can set yourself free.
So I think that we've run through a lot. We've kind of discussed and run through your valuation, your earning potential as an asset. Do you have any final aspects that you just want to touch on, or like a final takeaway that you think kind of summarizes the entire concept?
Yeah, I think we covered we hammered down quite a few points over and over again, and hopefully to our listeners, what we want you to walk away with is your ability to earn an income is worth a lot of money. It's an actual dollar figure. That dollar figure can fluctuate. It is extremely important that you leverage your earnings capacity to accumulate wealth. We've also gone through some examples on how that could be much more impactful than trying to seek out a super high return on investment in the stock market, for example. And we've also gone through some examples where you should protect that. You should also take advantage of it, and don't take it for granted. Think about your future self. Your future earnings may not be known, right? You may not be able to work until 65. There's a question mark at the end of that sentence, future earnings. When does it end, right?
Definitely.
So don't take it for granted. Recognize it for how valuable it really is. Take steps to increase it and protect it. I think that's what I would say I want people to walk away with. So sounds like a
awesome.
good place to stop.
Well, I've enjoyed this discussion. Thanks for talking me through it. And I guess that kind of leads into what we'll talk about in the next episode is viewing yourself as a business.
Good little teaser there. That'll be a fun one to talk with everybody.
Yeah.
Until then, thanks everyone for listening. Hope you enjoyed, and we will see you next time. Have a good one.
Yeah. Have a good one.